Welcome to the daily update, where I'll go over the action in the market for Wednesday, September 24th, and we'll see how things look for Thursday, September 25th. Okay, MegaCaps didn't have a very good day, and when they go down, the indexes go down, and that's what we see happening. We're losing that short-term positive conviction. It's pretty much gone away. Not completely, but it's pretty much faded now. Now, we can always get that back. We've got some big economic reports coming out on Thursday and Friday with the initial and continuing jobless claims, GDP, durable goods, the big core PCE report coming out on Friday. If those are taken as friendly, okay, that could help the market to go back up. Now, one thing that was interesting about Wednesday is if the buy the dippers tried to come in, they weren't successful. It seems to have happened up to this point. Are they stepping aside or are they getting wiped out with more selling? Now, we were below average with volume, so that's an encouraging thing. We've been above average with volume as we've been going up, and now we were above average on Tuesday, even though we had a down day, but then we had more of a down day on Wednesday, and we're back to below average volume there. So that's kind of encouraging. We're in that weak seasonal time that we've been waiting for now for a while, not necessarily anticipating it or forecasting that that was going to happen. We just have to go with reality that at least right now, this could turn around and go back the other way, but the weak seasonality appears to be entering in. We'll be watching the 20 period moving averages. That's kind of the first layer of defense to see if those areas hold up. All right, so right at the open, we had a higher open. The futures were fairly not really strong, but it did give us a higher open. But then right after that, we saw prices decline down below the daily pivot at 66.67. Then we went negative. We fell below the unchanged level. We went below S1 at 66.34. We did find support at a round number, 66.25, kind of around that level. And then we chopped between 66.25 to the downside and S1 to the upside. And we did close back a little bit above S1, so we were off of the low, but still a down day nonetheless. We were down 0.28%. Now, on a percentage basis, that's not a big deal, but you get these, less than 0.5% move down and then another 0.28% move down. It kind of starts to add up over a while, but it's not showing an awful lot of conviction, but we're not seeing that positive conviction that we had been seeing. We were below average with volume. We are still positive. As long as we're above the 20 period moving averages, we continue to be positive in that regard. But we are seeing some more short-term weakness that's starting to enter into the market. Interest rates did go back up. Now, not at a real threatening level, but if we see interest rates going up, that might start to put pressure on stocks to keep them going down. And of course, geopolitical things all over the place, but not really impacting the market all that much. Okay, some comments. MegaCaps and growth underperformed yet again. We saw that on Tuesday. We saw that again on Wednesday. When the growth areas and MegaCaps don't do as well, that's when the indexes don't do as well. We did have some Fed speak from Austin Goolsbee, said that he does not expect a recession. Okay, the market could have just went to the moon on that, even though this isn't the chairperson of the Fed, and might not be in favor of a series of additional rate cuts. Well, okay, kind of like a balancing type of statement there. No recession, but maybe we shouldn't cut rates. Now, the market's been really anticipating that the Fed's going to continue to cut rates, and they like that. So it depends. Did they focus more on the first half of what this person said or the second half? Probably the first half, at least in Tuesday's session. And we're still getting a warning signal from the S&P to VIX correlation. That's still giving us a high reading. We're starting to see some of our fear gauges go back up. Volatility risk premium is increasing. We're not seeing it much in the VIX itself, but I'll go through the charts and show you. And that's why I look at a lot of different charts because it's like, okay, the VIX isn't really telling us that a lot of fear is coming back in. I think the VIX was actually down a little bit. We'll look at the chart there. But we look at other measurements for gauging sentiment, and that's starting to go back up. But we're not seeing it necessarily reflected in the VIX. Okay, we just have the stochastics that are looking extreme positive, and these are a little bit slower, not the short and intermediate term, but the longer term charts. they're rolling over. They're not necessarily positive, but they're still in extreme positive territory. We don't have anything now in the intermediate term. We've worked off those extreme positive readings that we had been seeing. Even with the decline, excuse me, even with the decline, we're still more than 10% above the 200-day simple moving average. And that has been a bit of a concern. When we get too far away from that, price has a tendency to go back to the moving average. No change to the overall scenario. Probably won't be a change until core PCE comes out on Friday to see if the Fed has any kind of reaction to that or there's market reaction to it that might endanger the idea that there's still going to be cuts in October and December with the Fed. The dollar was up, interest rates were up, we're at 4.15%. Again, we get concerned if we get to 4.5%. And the concern here is that last week we came down, we tested 4% two times. We came down, bounced up, came back down, and now generally we've been going back up from that level. And so if interest rates do continue to go up, that could pressure stocks. Sentiment is still positive, though. We're a couple more ticks. If we drop below 55 here, we'll be neutral. But this is actually positive when you look at the number, but negative when you look at the context, because we were in the 60s, then we dropped to 58, now we're down to 57. So we tend to go with that, whatever direction sentiment is going, and that has been dropping lately. We're still positive with the trend, though. We're taking a bit of a hit, but it hasn't switched over to negative yet. And I'll show you those charts. With the bias being negative with the down day, I'm still keeping the momentum at positive. If we have another down day or a lack of real selling, or excuse me, buying coming into the market, I might switch this over to mixed. If we have a pretty significant down day, it might actually switch over to negative. Okay, so we did get the weekly MBA mortgage applications index. It was up 0.6%. Now, last week it was up huge because of the drop that we were seeing in interest rates, up 29.7% a week ago, but it still did advance this week. New home sales. Now, this was rather encouraging from the real estate perspective here. 800,000 were the new home sales. They expected 650,000. And also last time we had 664,000. So that was kind of a nice little surprise there to the good side. And are the mortgage applications where they were still positive, but a real drop off from the previous reading. Then we look at August new home sales, really going up here. We've been kind of range bound lately, going up and down, up and down. We broke out just a little bit here. And then we look at the 3-month average of home prices where they're actually declining. And that's probably helping the homes to be sold. Okay, so here we have from Real Investment Advice, market cap against equal weight returns. And that's been one of the issues here is that you have the equal weight index that's in red, which has been underperforming. That's the rest of the S&P, where all of the stocks that make up the S&P, I believe 503 stocks, they're all treated equally. Where in the weighted version of the index, you have the big stocks, the Google, Apple, Microsoft, and so forth. They account for a lot more of how the index actually moves. And we're seeing the market cap here actually going up, but we're still leveling off overall with the equal weight index. All right. And then we're still seeing a divergence here. This goes back all the way to 2020 into 2021, where we're seeing the S&P going up, which is the purple line. And usually the truck tonnage index, you can see for decades, they tended to hug pretty close to each other. But the S&P has been going up as this has been going sideways. And then our macro model evaluation suggests today's PE is roughly in line with fair value. Okay, this is Goldman Sachs. You can crunch the numbers any different way you want to try to come up with some either justification or that this shouldn't be what's happening. But they're coming in at 22.6 here with the actual. That's what we're doing for the real PE that we look at. But the modeled version here is right about equal with that. Okay. Don't know what that model is. Don't know how it's calculated. Don't know what components go into it. So we just kind of have to look at this for what it is. All right, we now expect the Fed to deliver its 2025 dot plot and ease in October and December. Okay, that's pretty much the takeaway here from this chart. Equity sector fund flows, we're still seeing most of the money going into tech. We're seeing a little bit of a drop off here with the financials. because they've been underperforming lately. But usually when tech is really outperforming overall, that's the big growth area. And so that's typically where we see most of the money going, where we're seeing money coming out of healthcare, out of energy, a little bit out of communication. That's another big growth area here. That's the orange line that you see. But I look at that in the intermarket analysis video over the weekend and do a comparison. It's still holding up quite well when compared to the S&P. All right, investor bull minus bear spread. I usually go over this in Friday's video. This is almost a week old now. This survey that comes out from individual investors where they had never gone bullish. And that was giving the market more room to run to the upside because these folks weren't giving really high readings. Typically, individual investors, which is that's what you and I are, and anyone listening to this video, we tend to follow what's already happened. If something's going up, then we jump on it. Now, I am a momentum type of analyst when I do things. I don't believe in buying on dips. I don't believe in, you know, necessarily trying to pick a downward move as we're going up. We let the charts come together. But these folks tend to do it from a more emotional standpoint. They have other jobs. They can't sit around and evaluate the market all day, where I've kind of dedicated myself to being able to do this. So they've been real pessimistic. But now it seems like, okay, maybe they're going to be a little bit more correct if we continue to go down. Okay, market implied U.S. recession probability. I look at the average here, we're at about 20%, which is not a very high percentage when you take all these different components and say, okay, does it look like we're either in a recession within the next year or are we in a recession now? Only 2% of our indicators here are saying that. Systematic positioning, this is when you follow a system. You don't really pay attention so much to what's happening in the market. We seem to get a lot of these charts. And when the market's been going up really solid the way it has been, the systematic approach tends to perform better. Just like getting into an index mutual fund or an ETF like the SPY, that tends to perform better where you can just kind of get into it and hold it when the market's going up overall. When you try to maneuver and change things around and get in and get out, that tends to underperform. That's more of a discretionary approach. And because you're moving things around, the performance can quite often take a hit. But then when we're going down, it's just the opposite. The discretionary tends to hold up better, and then the systematic approach. See how the blue line here was really going down when we were tanking back last spring. Okay, small cap equity positioning, just still seeing it a little bit higher here, but the small caps really haven't been performing all that well so far this week. Sentiment versus income, if you looked at just the yellow line, which is kind of hard to see down here, you would miss the huge chasm that's open between how wealthy people feel and about the economy and how poor people feel about it. Okay, just this is something that's happened for all of history. The rich people tend to be more better off in the financial sense than the poorer folks, but that's always existed. But there's always been this war between the two. But generally, if you're battling more with trying to keep up with things financially, that's more stress on you, and you're probably not feeling as good about things. Okay, the pay gap in 2025, the differential between the bottom and the top of earners has grown to 530%. This goes back to 2019. So, yeah, the people that make money tend to make a lot more money than people that don't make as much money. All right, gold, looking at 1999 versus today, this is trying to even things out where we finally did break to an upside here. Valuations, again, you might want to pause this and look at it. I do talk about valuations all the time, and I also cover that in the intermarket analysis video. But there are some stocks here that are considered inexpensive on a PE ratio. Now, I don't use PE ratios to analyze whether I want to get into something or not. We look at it at the market level, but it's been overvalued for a long time. There are folks that use fundamental analysis and they try to get in when something's cheap, and then when something becomes expensive, that's when they look at getting out of it. And that would appeal more for this type of a chart that you see here. What are we looking at as far as inside of this? It says, and it's warranted, but it's not the entire market. Take a look at the PE and firms of S&P 500 companies. So these are inside the S&P that are below 100 billion in market value. The story is very different than the mega caps. Okay. Interesting thing there. AI takeover. AI related stocks have accounted for 75% of the returns for the S&P 500, 80% of earnings growth, and 90% of capital spending or CapEx since ChatGPT launched in November 2022. Not a real surprise there, but here's some data to back that up. Okay, so looked like maybe we were going to get a little pop here. We saw a bit of a rise up going into the close on Tuesday, but we got a higher open, but then quickly, immediately saw selling coming in. We came down, hung out at the unchanged level for a while, and then we started to break lower, breaking below S1, just sliced through that pretty quickly. But we did find some support here at the 66.25 level, bounced up, came back down, and bounced up a little bit of a recovery going into the close, slightly above S1. Okay, not much of a change that I saw with the initial overnight session, but this is many hours. Europe hasn't even opened at the time I'm recording this here. But we didn't see much of a change overall before the market opened. The futures were just kind of humming around, and then we saw most of the weakness coming in during the trading session. And we also saw that in Tuesday's session as well, where the futures were kind of tame. And that's what we've been seeing lately. We're not, at least right now anyway, we're not seeing these huge gap ups or gap downs. We're seeing, I mean, sometimes we get them either up or down, but most of the price movement is actually coming while the market is open. And seeing a bit of a hit here. The red line is still above the blue line, which we would like to see the blue line above the red line, but both are going down, and that is negative when we look at intraday large cap growth to large cap value. Coming down and still below the moving averages here, not really breaking out of this range yet when we look at S&P growth to value, not showing any strength, but not really breaking down either. So if we continue to go down, that would mean it's more negative naturally. Okay, and growth was down more than value for the large caps, down more for the mid caps, down more for the small caps. And so we're coming back down now. We were doing a little bit better here with the small cap growth to value ratio, but we were concerned as the small caps were going up, but we were going down with this ratio. Now the ratio is starting to come back down as well. And we were seeing actually a breakout with the mid cap growth to value, but mid caps have been just going sideways here. But it did take a bit of a hit on Wednesday, and we're not able to get back above the 50-day moving average with the S&P growth to value ratio. Bigger picture, we're still in an uptrend, but we need to get back above this 50-day moving average. This has been a little bit of a concern going back to the beginning of August when this really topped out and started to come down. And a little bit of a pullback, but not falling apart with this growth to value ratio. Still holding up okay with discretionary to staples here. And then we look at the trend where we are coming down with the green line, coming up a bit with the red line, but we are still in a strengthening trend. We're above the moving average, even though the ADX is rolling over a little bit, and the green line is above the red line. Very similar thing here. Still a strengthening trend, green line above the red line, but showing some weakness. And we did drop to slightly below average with volume. After the last three trading days had been above average with volume. And then looking at the gamma exposure, we're kind of far away from this now. We were looking at the 6,700 level. We saw a lot of gamma exposure, this blue line, and they both intersect with each other. And so it says the gamma flip point is 65.77. So, and we're still above that. We're at 66.38 if you round that up. So if we fall below 65.77, that's when things could actually turn a little bit more negative. That's why we want to keep an eye on this and see if we continue to fall, if it's going to actually turn more negative or not. Okay, and then we actually, yeah, we declined just a little bit here with the VIX, coming back down into the line chart on a closing basis, but and still mainly above the moving averages with the bar chart. And wondering, are we going to pick up? I've been saying this over and over and over, going back for a couple of months now. But if the VIX does start to really go up, that's likely to mean that stocks are going down. But we saw the VIX going up on Wednesday. But we are picking up a little bit here. It dropped off on a closing basis, but the volatility of the VIX is above both of the moving averages. This is where we're seeing some concern that we're not seeing in the VIX right now. This is a correlation between the VIX and the S&P, and we're above this dashed line. This is 3 days now that we've been above this dashed line, meaning the market is more nervous about things, meaning that, okay, there's some more negativity coming into the market. Now, we're not really seeing much in the way of sentiment changes here. We actually went up with this fear gauge on a down day, but we went down a little bit here with this fear gauge. So not confirmation there. We're going up a little bit with the daily chart of the equity put call ratio, but we're still really declining here with the 5-day chart. We're below this red line. And I don't show this one as much here, but this is a longer term look at that previous chart just to show you where we're at and then how price action actually was acting during that time. And so now we still have more room to go to the downside with this overall ratio. But at some point, when we finally bottom out, sometimes that can mean that the market is bottoming out as well. And we are still declining with the 10-day average of the equity put call ratio. This is another one that we're not seeing in our other sentiment gauges. Volatility risk premium starting to pick up. If you remember, we were climbing up, climbing up, climbing up in July, and then we had that employment report for August come out, and the market really took a dip during that time. And then we saw the volatility risk premium coming down. Is this setting up for something that we're not seeing? That's why I look at a lot of different charts. Advanced decline line, a little bit down, both based on price and volume, but still holding up for the most part. And we're a little bit below the midpoint with the short-term advanced decline ratio, a little bit above the midpoint with the intermediate term advanced decline ratio. And this is still holding up. When we look at it based on price, which we have to follow, price is the ultimate indicator. We are below zero here, but we're still above zero when we look at this based on volume. And not really seeing much conviction with our advanced decline oscillator, just right at the midpoint here. And saw a drop off in new highs. Now, when we saw that expansion in new highs on Tuesday, that was because we had gapped up a little bit with the open, set a lot of those new highs, and now we've been going down ever since that time. So we're still declining with the 5-day chart, but we're actually going up a little bit here with the 10-day chart. And we're seeing a bit of weakness here with our smart money indicators. We are declining with accumulation distribution, although the bigger picture is we're above the red line, so that's positive. Shorter term, though, we're declining below the moving average, below this red line. So that's positive in the bigger picture, negative in the short picture. And we're turning down now. The Chaikin money flow, which had been holding up fairly well, is now starting to show some weakness, and the red line's going down. And we dropped below the moving average with the Chaikin oscillator. We had declined after Tuesday, but we were right about at the moving average. Now we're falling down below them. I know it's really hard to see. That's that faint red line here on the chart. But now we're actually looking negative as we look at the context for that declining. And coming down, but still positive with the vortex. And we're still just hanging out a little bit above the moving average with the S&P advanced decline line, starting to drop a little bit below here with the NYSE, but we're seeing more weakness with the mid caps and the small caps below the moving average. And here's the stocks in the S&P above their 20-period moving averages, just cannot seem to get back above 50. And we were actually encouraged after Tuesday when this improved on a down day, but now it went down on a down day. A little bit of weakness, but still above 50 with the 50-period moving average study, and still holding up okay here with the 100-period moving average study. And we're flat to slightly up. I guess we were unchanged with the 200-period moving average study. So now we're thinking, at least I am, this dashed line up here. This was a pivot point that was already on the chart. We came about up to that level, and now we've been seeing the market looking a little bit more vulnerable as we're coming back down. Is this going to end up meaning something? It didn't mean anything for the NASDAQ and NASDAQ 100, which usually these pivot points really do mean something. Is the one here for the S&P, is that going to come out and actually mean that we're hitting some resistance here? And then down on the bottom, we were below average with volume. So not much of a change with our 20, 50, or 200 period moving average study on the S&P, dropping off and actually falling below the midpoint with the Stochk RSI. This is one of our short-term indicators that we use to see what's the conviction in the short term. It's turning a bit more negative with the Stochk RSI. It's no longer extreme with the Williams percent R. It's dropping down, but still above 50. And we're dropping down with the CCI 14 and the CCI 20 chart. So, and then we look at the next one here, stochastic. So in the short term, we pretty much have lost that positive conviction. We are rolling over, but still extreme in the intermediate term and rolling over with the long short-term stochastic and coming down and dropping just a little bit below the midpoint. Now we're still green with the force index, but when we drop below the midpoint, that's like the initial area of looking more negative. Still looking okay here, slowing down with the green line and the blue line, but we're now dropping below these lines. If we stay below this, these lines will roll over, but right now they're not seeing that much vulnerability at this time. And we're down in the +2 channel here with the standard deviations chart. Then intermediate term, we're actually dropping a bit negative with the balance of power. We fell below zero, and so that's turning more negative. Still positive with the go, no go, darker blue bars there. Still coming off of the highest high value with the S&P here with this chart. And we're in day 101 now with the Landry Light uptrend that started way back at the beginning of May. Day 95 of the proper order uptrend that's still intact for right now. Still going up with the TTM squeeze, slowing down a little bit here, but it hasn't rolled over to look dark blue yet. And still looking positive with the Arun. Buyers are still outnumbering sellers here, and that's why the oscillator is positive. Still hanging out just barely above zero with the ease of movement. And then we look at the S&P McClellan oscillator, below zero, not showing a lot of conviction to the downside, but still negative nonetheless. And I've been trying to point this out too. As we were going up with the S&P, we were setting a series of higher highs with the McClellan oscillator, and that might be feeding into what we're seeing right now. So we're still declining based on price, but we're still advancing based on volume. It's slowed down a little bit here, but this is giving us a mixed picture. And we're seeing a little bit more conviction here on the negative side with the NYSE McClellan oscillator. So now we're starting to see a bit more of a decline based on price, a little bit of a downtick here based on volume. When we look at the summation index for the NYSE, and this is strange here. No, it was strange yesterday. It's actually looking a little more negative here. We're going down with the Swindler trading oscillator based on price and volume. They were advancing after Tuesday's decline, which was strange. Now they're more or less coming in step with what we're seeing. And we're still looking okay as far as sentiment. And you can see price is looking more negative. It's further below the moving average, where we're still above the moving average when we break this out based on volume. So volume is still under the surface. It's still holding up for right now. And not really seeing much of a change here with the PMOs that are rising. We're still under 50 with the buy signals and a little bit of a drop off with the PMOs that are above zero. And still okay here in the short term with the slope oscillator, rolling over a little bit, but still above the moving average with the MACD. So we are seeing some vulnerability here, but we're still positive with all of our momentum oscillators. A little bit of a rollover with the Copic curve, but still above the moving average. And we're no longer extreme with the Sean trend meter. We were in this dark green area. Now we're starting to decline. We're no longer extreme with the money flow. It is now declining. And we are declining, but still above 50 with the ultimate oscillator. Declining, but still above the moving average with on-balance volume. No longer extreme in the intermediate and short term with the RSI, and declining. And still neutral with the Elder's Impulse system for the S&P. Still positive with the parabolic SAR. Now, these dots are getting kind of close to price. So if we see any more of a decline, it would not necessarily be a surprise to see if a dot comes in on top. And we don't know. We could bounce up out of this and everything could be just fine. But if we see more weakness, I count this as a primary indicator. And if this starts to turn negative, that would turn the intermediate term more negative as well. But this short and somewhat intermediate term, we're still above this green fluorescent moving average here. And that's a 10-period simple moving average. And so far, that's shorter term than what I look at. I use a 20-period simple moving average. And so far, this is holding up as support. And our intermediate term trend, still looking okay. The red line, the blue line are still going up. Price has not really dropped definitively below either of those lines yet here. We're watching all the moving averages. We're going to be watching the 20-period moving average. And we're not extreme now with either the 20 or the 50. We've seen enough of a pullback. We saw that after Tuesday with the 20-period moving average. And now after Wednesday, we're dropping down a little bit here with the 50-period moving average study. But we're still 10% above. We're 10.46% above the 200-day simple moving average. And again, in the past, when we got above this level, that is quite often where we saw more significant pullback. And just kind of dancing around, looking a little more negative with the bullish percent index. We saw a bit of a drop below its moving average. We are declining a bit with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. And still above this R1 support level. That's still a ways away. We're looking at 64.68 at this R1 point here. As of right now, we're down 0.4% on the week. And still above this trend channel, going back to 2009. We haven't seen enough of a decline there to pull this back, at least yet. And we're looking a little more negative with the Heiken Ashi now. It has a black candle there. We're positive with the Kagi chart. It's black, but now pointing down. It's positive when this points up. But we're still positive with the Renko chart and still positive with the three-line break chart. Long term, still holding up pretty well here with the 150 and 200 period moving average studies there. And then looking at the different sectors where we had energy, that was the strongest sector, and utilities, and then discretionary was okay, and then staples were up as well. But the tech and communication, those are the areas that lagged behind. So looking across the different models, we've turned to negative now with the mid caps in the short term. All the other indexes are still positive, and we're actually in an uptrend now with the dollar. It's been bouncing up enough. Now, if the 10-year yield keeps going up, the dollar keeps going up, and the defensive sectors keep improving, that might put some pressure, more pressure on stocks. So we had right after the market closed here, we had the NYSE summation index cross below its 20-day simple moving average. Okay, gold set another new all-time high. All right. Then earlier in the day, we had a BPI cross above 80. Didn't really stay there, and then the Nasdaq got above 22.6, didn't stay there. Canada set another new all-time high. We initially saw some weakness in healthcare. It crossed below 50, but then later on, the Nasdaq went below 22.5 and then 22.4. And a lot of red here with the big boxes. Tesla, that kind of helped the discretionary area to stay up a little bit better. But both of the Google stocks were down. You had Apple down. Not huge moves here. Oracle, 1.771%. But when you see a lot of red here, that's what drags the indexes lower. So the Dow, and this is another pivot point here where we came right up to it. We on an intraday basis, we got above it and then closed below it. Are we starting to come down from this pivot point here when we look at the Dow? And we are neutral though, still with the diamonds, looking at the Elder's Impulse system. And this is the other pivot points that I say, okay, we're still hanging out right around this pivot point for the NASDAQ. We closed up off of the low. We were only down about 1/3%. But it didn't seem to matter that we came up to this level as resistance. We blew right through it, but now we're starting to come back down. But we're still neutral with the NASDAQ. Also, we came right up to this overhead resistance level, went above it. Now we're starting to come back down from it, where we hit it more squarely with the S&P 500. Just an observation to see if that's going to play out and mean anything. And we're neutral with the Qs, looking at the Elder's Impulse system. Rolling over a bit here, but still positive with the momentum for the NASDAQ 100. Still above this long-term trend line with the NASDAQ weekly chart. And just kind of starting to chop around now with the small cap S&P 600 index. And we were down a little bit more here. Still looking pretty good as far as a chart pattern, though, with the Russell 2000 small caps. Neutral with the small caps with the Elder's Impulse system. Mid caps, they're just dropping down into the lower end of the range here. They must have passed below a 20 period moving average or something, which I don't put on this chart. This is why Stock Charts has them in a short-term downtrend. But they've also turned negative with the Elder's Impulse system. And coming off of a recent high with the Wilshire 5000 and the total U.S. stock ETF, financial sector was down, but still above its 50-day moving average, but continuing to underperform the S&P on a ratio basis. The FANG index also got hit again here. And then we had Apple that was down 0.83%. Microsoft was up 0.18%, so not very much of an advance there. Amazon was down almost 1/4%. Google down 1.8%. Meta was up 0.7%. And then Nvidia was down 0.82%. Tesla, it was up almost 4%. That helped the discretionary sector. And then Netflix was down over 1%. You take all those together, these really big stocks, and that's why the indexes are dropping right now. And seeing a bit of a drop off here with the short-term correlation between US and world stocks, still for the most part strong with the longer-term correlation. And we did go back up. We're getting more into the mid-60s with oil and the dollar. Enough of a bounce up here, but we're still in a longer-term downtrend, both here on the daily chart and the weekly chart. And we're going back up slightly, not all that much, but you see how we came down and tested the 4% level a couple of times, and we've been coming up from that level since then. And just kind of going sideways to slightly lower now with the 10-year based on price. And still okay with the Qs to S&P, even though we're rolling over a little bit. We saw discretionary to the S&P coming back a little bit above the moving average, We are declining, but still above an advancing moving average when we compare large cap growth to value. So we're below the moving average with the large caps, coming down, but above the moving average with the mid caps, and now back down below the moving average with the small caps. So what's our outlook then? We're still above that support level. We're still seeing a lot of negative divergences, but we're still positive on all three time frames. We're going to get initial and continuing claims. The third look at GDP that has a growth component and an inflation component. And a month ago, when we got this report, it was like the best of both worlds. The growth part went up, and the inflation report stayed the same. We'll see if we're going to get a similar number in Thursday's session. Durable goods will also be coming out, and then we get the advanced international trade in goods as well as wholesale and retail inventories. I track this number, but it's not really that influential. And then anything geopolitical that could happen, whether domestically in the US or outside of the US. But there's a lot of crazy stuff going on, but the market's still doing what it's doing. Okay, and then on Friday, we're going to get personal income and spending as well as core PCE. And here's a look at what the previous readings were, and then if there's a forecast for that. We did get 3.3% for GDP last time. Seasonality, not really that positive, but not all that negative either. We are dealing with the week after options expiration, which has been down more than up going back to 1980. When we look at September 25th, we're neutral to negative with the Dow and Nasdaq. We're just flat out negative with the S&P. And this is also the seasonality here, where we never really went down with this part of the negative seasonality. Maybe it's starting to make up for that now, but typically we would see a little bit of a bounce before we see some more weakness going into the end of the month. This also shows how September is negative, shows how September is negative, shows how the second half of September is negative. And this is a newer chart here. The Carson folks came out with this negative seasonality going back to 1950 for the last part of September. This also goes back to 1950, which kind of confirms what we're seeing as far as negative action during September. Okay, now on the negative side, we're looking weaker with accumulation distribution. Shorter term, we're negative. The bigger picture, we're still positive there. But the Chaikin money flow and the Chaikin oscillator are now negative. We're still negative with the McClellan oscillators and summation indexes for both the NYSE and S&P. The swing and trading oscillator is now negative, both based on price and volume. And we're turning negative because we're dropping below the moving average with the bullish percent index for the S&P. Positive side, though, our ratios are still holding up okay. The parabolic SAR is still positive. We're still positive with momentum. And when you look at the NASDAQ 100 and NYSE bullish percent index, they're still above 50, even though they're declining right now, because I don't put moving averages on these, where I try to track the S&P bullish percent index more closely. ESA movement is still positive. Money flow, ultimate oscillator, vortex, and the momentum for the NASDAQ 100. Those are showing weakness right now, but they're still hanging on to being positive. And then the financial sector, but it's still underperforming the S&P, but our longer term special K oscillator is still positive there. And here are the pivot points for Thursday's session. So our conclusion, we're positive and we're above support for right now. In the short term, we're fading with that positive conviction. It's pretty much gone away now. And now we're going to be watching the 20-period moving averages. If we see more of declines, intermediate term, we're positive, but seeing some weakening. And then these negative divergences that we've been seeing now for quite some time, we're starting to see some follow through price action going lower as well. And we are positive in the long term, but we're still more than 10% above the 200-day simple moving average. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.